Welcome, traders. In this lesson, we're moving from analysis to execution, focusing on two of the most critical pillars of long-term profitability: risk-reward calibration and trade management. No matter how good your analysis is, without mastering these, success is left to chance. Let's build that foundation. So, what will we cover? We'll start by understanding risk-reward, what it is and why it's non-negotiable. We'll then discuss the importance of trade management within a smart money concepts framework. It's not just about entering a trade, it's about managing it until the very end. Finally, we'll give you an overview of the key concepts you need to implement today. Let's start with the absolute basics. The risk-reward ratio is simply the measure of your potential profit compared to your potential loss on a single trade. If you risk $50 to make $100, that's a 1 to 2 ratio. Risk $50 to make $150, that's 1 to 3. Why does this matter so much? Because you don't need to win every trade to be profitable. With a positive risk-reward strategy, you can be wrong more often than you're right and still come out ahead. It is the bedrock of consistency and long-term profitability. Now, how do we calculate it? It's a simple 3-step process that must be done before you enter any trade. Identify your key levels: your entry, your stop loss, which is your predefined exit point to limit capital loss, and your target or take profit, the level where you secure your profits. Do the math: risk equals stop loss price. Reward equals take profit price. Find the ratio, divide the reward by the risk. As the diagram shows, your stop loss is below your entry in a buy trade, and your take profit is above it. The goal is to ensure the distance to your profit is greater than the distance to your loss. Placing the trade is only half the battle. Trade management is what you do after you're in. This is how you maximize your winners and protect your capital. Key principles include scaling in and out. You don't have to enter or exit all at once. You can add to a winning position or take partial profits along the way. Moving to break-even. Once a trade moves sufficiently in your favor, a powerful technique is to move your stop loss to your entry price. This eliminates the risk from the trade. Trailing stop loss. As the trend continues, you can manually or automatically trail your stop loss behind the price, locking in profits as the market moves. As this chart shows, the trailing stop follows the price up until a reversal hits it and you re-stopped out with a great profit. Adjusting position size. Your trade size should always be calculated based on the specific risk of that trade, not your account balance. This is paramount. Let's look at a practical scenario. Here we have a buy trade. We have our entry point. Below it, we have our stop loss. The area between the entry and the stop loss is our risk taken or potential drawdown. Above, we have our take profit target. Notice how the distance to the take profit is significantly larger than the distance to the stop loss. This is a visually strong risk-reward setup. The trader here is risking a small amount for a much larger potential gain. This is the blueprint you should visualize for every trade you take. None of this works without the right mindset. The psychology and discipline to stick to your plan is what separates amateurs from professionals. This means sticking to your RR rules. Don't move your stop loss further away hoping the trade will come back. Don't close your take profit early out of fear. Avoiding emotional decisions. Greed and fear are your biggest enemies. A predefined plan is your shield. Journaling your trades. This is non-negotiable. Record your reasoning, your risk or reward, and the outcome. This is how you find your edge and continuously improve. So, let's recap the key takeaways. A solid risk-reward ratio is not a suggestion, it's essential for long-term survival and success. Active trade management is how you maximize your profits and minimize your losses on winning trades. Ultimately, discipline and consistency in applying these rules are more important than any single trade. As you move forward, practice these concepts in a demo account until they become second nature. Review and adapt your risk-reward strategies regularly. What works in one market condition may not in another. And finally, keep a detailed trade journal. Your journal is your most valuable tool for continuous improvement. Master your risk, and the rewards will follow. Thank you for watching.